gap, which in analysis terms is quite typical, and subsequently has started to head back down from there. The MACD has crossed the downside as well, which indicates...
This is the moving average.
This is the moving average convergence divergence. So basically, it's the difference between a couple of moving averages and then an average taken off that indicator. And we're seeing a crossover to the downside, which indicates that there's further weakness to be had in this stock. So for the time being, it looks like ICI is probably heading lower.
So how much lower then, according to these charts, could it have to go?
It's difficult to say from the charts. It could certainly head back down to that previous low, around about 85 pence.
So it could go all the way back down?
It certainly could, and with ICI not performing too well fundamentally, it certainly could go lower. But I would place an initial target at probably £1. That's a figure that most people would be looking to buy at.
What kind of time frame are we talking as far as this move is concerned? Would you expect it to be quick, or would it just be a gradual decline? I
think it will probably be a gradual decline. It'll probably fall day by day by a small amount, and it'll probably get down to £1 in the next couple of weeks, 2-3 weeks at most.
Well, that's quite quick. They're going from £1.31 to £1.
Yeah, but trickling lower bit by bit every day. So
you'd be avoiding ICI or still selling ICI if
you're long, you'd probably be looking to get rid of it. Yeah.
Okay, well, let's look at a couple of other constituents on the FTSE. So we've got Boots and Dixons. Now we're going to have a look at Boots. What's going on here?
Recent upward trend. Boots has done fairly well. It's bounced off these lows all the way from 520 all the way up to...
It's a good run, hasn't it?
Yeah, all the way up to 640, but it's broken a trend line in the last couple of days. And that was primarily on the back of a downgrade from one of the big investment houses. Significant that it's broken that trend line, indicating further downside. It's also gapped through that trend line, indicating that there could be an accelerated move to the downside. What's also important is the relative strength index, the RSI, which is shown along the bottom here, which is showing divergence. Now,
what does that mean?
Well, it basically indicates that the underlying share price is actually quite weak. Although the share price has gone up from when we marked out the RSI, it has gone up. The RSI has actually started to trade lower, which indicates that the move up in the share price is not actually that strong. So we could see probably a move down to around about 620, the previous low in Boots. Not looking too good at the moment, though. So
still cautious on the outlook for Boots, despite the run that it's had. Do you think that run is close to coming to an end?
Despite the run that it's had, I think that run has probably come to an end.
Okay. Well, let's have a look at Dixons, because Dixons is one that's interested me this week, actually, because it was up almost 4% on Tuesday, 2% on Wednesday, almost 2% yesterday. It's coming back slightly today, but there hasn't been a lot of news on the stock this week, and its shares have had a very good run. And you're saying that from a technical point of view, it's looking good for the stock. It's
not looking bad for Dixons. It's moved all the way up from 80 pence to around about 130. And although we can't see it on the graph, it's actually retraced 38.2% of that range, which technical terms, in Fibonacci terms, is relatively important. It's found support at around about the 105, 110 level, and what we've seen in the last few days is it basically had formed a congestion pattern towards the last couple of weeks, but it's broken out of that pattern, looking to do it with some size and speed as well, and also the MACD has crossed to the upside, indicating possible further upside for the stock.
So momentum's still favouring Dixons.
Momentum's favouring Dixons. I think fundamentally the stock's a good stock as well.
Okay. Manoj, thank you very much for joining us this morning. Manoj Labbar there from Cube Direct. European bonds are rising this morning as investors speculate over how much central banks in Europe and the US will cut interest rates to spur growth. Well, Bill's been watching all the developments at the big board, and there he is. Bill.
Well, Chantal, that's what it is. The first date will be Wednesday at 7:15, while the Federal Reserve drop rates a quarter or half of 1 percentage point. Then we go to July the 10th. What will the European Central Bank do, and what will the Bank of England do? And this is what really everybody is looking at, whether it be the bond market, the foreign exchange market, and probably even the equity markets. Well, Chantal, as we saw today, more good bond news. First out of Germany, we saw producer prices on a monthly basis, biggest decline in 10 months. And then we had the French government saying looks like growth could be the weakest in 10 years. That coupled with, remember, we saw harmonized CPI in the Eurozone drop to 1.9% this week. We also saw more dismal economic data coming out of the Dutch central bank. Growth could only be 0.4% this year. Economy could lose another 100,000 jobs. And the Bundesbank said it looks like by this winter, unemployment could reach 5 million in Germany. But it's still a question it only took, and this is really very interesting, yesterday morning, when we opened, the yield on the 2-year, which of course is the most interest rate sensitive, whether it's the European government bonds, UK gilts, or even the U.S. Treasury, most interest rate sensitive, were yielding 2.08%. Then there was the article of that from John Berry at the Washington Post when he said he expects the Federal Reserve to drop rates 0.5 of 1 percentage point.